Hi, I'm Don McCulley.
And I'm Andrew Kuykendall. Welcome to another episode of This Stuff's Complicated, where we take medical stop-loss captives and try to make it something you can explain to your parents.
Or your children.
Your choice.
Okay, then. So, we're going to talk about picking a contract. Does that t-shirt have any relevance to it?
Well, if you want to get hyper-technical, and I often do, what type of cover do you have for your insurance? And for me, that got me thinking about great cover songs and great cover bands. This t-shirt is the alligator from Jerry Garcia's very famous guitar. And what's your favorite Garcia or Grateful Dead or Garcia-related cover?
Well, the last show I saw of Dead & Company at Folsom Field included a walk-on by Dave Matthews, and they covered All on the Watchtower.
Nice. I'm also picking a Dylan song with Simple Twist of Fate.
There you go. And with that, we'll move into picking a contract. So really, let's talk about on a high level what kind of contracts are offered in insurance. And the historical property and casualty cover was called an occurrence contract. And when that became problematic, then they invented something called claims made. An occurrence contract is more like fully insured. If the claim happens during the policy, the fully insured carrier will pick it up for the life of the claim. In stop loss, it's more like a claims made policy in property and casualty vernacular. And what that means is if the claim occurs during the contract and is submitted for reimbursement during the contract, the claim is made and paid, then it's covered.
So is that similar to how we would consider a run-in, a paid? Help me connect the dots between the different terminology.
So throw occurrence out the window because that doesn't apply in our world anymore.
Great.
But to make our contracts look like occurrence, you talked about run in and run out, and in the property and casualty world, they might be called nose and tail. But let's start naming what the contracts are. So first you have to decide with your stop loss partner, what's your baseline contract? So some carriers we've talked to use a baseline of 12-15, right? Which means if a claim occurs during 12 months and is submitted for reimbursement within 15 months, that claim will be reimbursed, just in an oversimplified manner.
And that 12-month period, the 15-month period overlaps the 12.
Yes.
So to break it out, if the policy begins on January 1st of 2000, the incurral period is until 12/31 of 2000, and then the pay period is through 3/31 of 2001.
To put a fine point on it, thank you. That's exactly right. That is what some people consider to be their par contract. Like that's the dollar they use for what starts to include run in and run out, right? We use 12/12 TLO on our fully insured. So TLO means terminal liability option. It gives you that extra 90 days like we talked about the 12/15. The reason we use 12/12 TLO is it most closely matches what our employers experience in our mind, and it's easier to renew into something that we feel mirrors an occurrence contract, because then we're moving into a 12/12 to a 24/12 and a 36/12. So we're putting a stake in the ground that says any claim after this date will pick up in this program, right? So having said that, the reason we never adjusted back to 12/15 and 12/18 when it was suggested or people started selling it that way is because I feel that recurring 12/15 or recurring 12/18, which is probably more popular these days, both overinsures and underinsures. And a few years ago, it even left gaps in the contract. So by overinsuring, you're overinsuring the first 6 months in a 12/18 on a renewal, and the first 90 days of a 12/15 on renewal. You're overinsuring those first 6 or 9 months, 90 days or 6 months, right? And you're also underinsuring if something comes in after that reporting period. Now, gapless came into vogue and everyone's added gapless. So there's really no gaps. Theoretically, there shouldn't be. But as we also talked about, 9 out of 10 E&O claims come from stop loss, so never say never. So in a run-in situation, when you're coming out of fully insured, you do not need to buy a run-in contract because that's an occurrence contract. You only need run-in when you're coming from another self-funded platform, and either our run-in is more affordable or they don't have run out, right? That's the choice they have. And then it comes down to dollars and cents. On run out, it's just a matter of how much time you need to align your claims to get reimbursed as you're switching from one platform to another. It might be a stop loss carrier. It might be a change of TPAs, but those are where the the discrepancies start to show up and claims start to get a little funky and possibly fall between the cracks. So that's where falling between the cracks is supposed to get picked up by Gapless.
And within our captive platform, we feel very strongly about this, and we only deal with run-in contracts. We'll start with 1212 TLOs and go 2412, 3612 to paid.
Right.
All of these are contract types that we feel help protect the member most effectively manage that risk. And from the captive perspective, we want to make sure everybody gets the coverage that they purchased.
Right. Because at the end of the day, the claims are the claims. They don't care about the contract. They show up and ask for money when they feel like it, right? We've been surprised several times with claims not showing up in any kind of trigger diagnosis or anything. Like all of a sudden, it's like, where'd that come from? Well, it's going to get reimbursed and then we'll deal with it. So really, I think the biggest thing that we haven't touched on in this episode is since we sell a 1212 with TLO, people talk about immature contracts, right? And while I understand why they call it an immature contract, our employers still have 12 months of claims in the first year. They just happen from the 75th day to like the 75 days after, right? So 18% of claims happen after a contract year ends, right? So if you use your 1/1 to 12/31 of 2000, during that first period of 2001, about 18% of claims manifest themselves. So an immature contract was the industry parlance when stop loss was focused on bigger employers. Now it's just a matter of, is that a flavor you're comfortable with? Because the only time you will see an immature contract cost a lot on renewal is when the claims are higher than expected, right? If not, it aligns. People think there should be a standard load of about 20% on renewal when you're doing a renewal of an immature contract. If your claims run at expected or above, you're getting that number added to your contract plus some, right? If they come in just below or at expected, a 20% load gives you that same margin of safety the underwriter wanted in the first place. An immature contract does not matter if your claims are lower than, say, 70% of max, because now you're just going to have a lower than average renewal because you are being rewarded for taking the risk. You're assuming risk. You're either managing that risk or it's not occurring because you've got a healthier population, and you're being rewarded for it. You have more cash than you needed because of the way the claims manifest themselves. So to wrap up, right, there's three things we want to talk about in this picking a contract. There's the type of contract. So we started with occurrence versus claims made. Then we walked into run out, and I think we covered all the whys and hows there. Hopefully we didn't miss anything. And lastly, the one that bothers me the most is calling it an immature contract. It's not an immature contract. It's a standard contract that some people just don't understand how to use, and we are advocates of. When I say don't know how to use, they aren't comfortable explaining how the renewal works. So with that, Andrew, did I miss anything in this episode?
Nothing from the episode, but what the heck is going on there? Is that a table tennis paddle?
It could be a really weird golf ball on a tee. I really can't tell you. Years ago, when I was getting out of commercial real estate and getting into insurance, I'm going to bore you with a personal story. We had a belief in commercial real estate to dress Yiddish and think British. And at the time, I always thought of the Brits as being funkier dressers than us. So I started wearing funky socks when I got into insurance. And in some places, people know me as the funky sock guy. And so that's it. Like you have cool T-shirts because you're a musician. I wear socks.
There's worse things to be known for.
And at least I wear socks. So with that, we're going to wrap up this episode of This Stuff is Complicated. I'm Don McCulley.
And I'm Andrew Kuykendall. Thanks for joining us.
Thanks for joining us.